Live. Hello, Kevin. How you doing?
Very well, Baldwin. How's everything today?
I'm very well, thank you very much. Welcome to the. I think this is the fifth episode of the Emerging Frontiers TV episode, and today we're going to speak about how to make frontier market private equity, and I guess private equity in general, more accessible to smaller investors and private investors. And Kevin, I mean, it's interesting because just before we hit the broadcast button, you were showing me an article that appeared in the New York Times, which has a very catchy title called "Behind Private Equity's Curtain." And I think it's something. It's pretty much a sign of the times, right? That we really need to challenge the way private equity is being done, right?
Yeah, I think that's absolutely right. This article is just another data point in the overall theme and thesis that financial services has basically become broken, and that it's time for individual investors to regain control of their decision making and regain control of their destinies. Right? I thought this article was eye opening.
Yeah, because what it's really all about here is that, somehow it's pretty much like most people don't have another alternative to a bank to put their money. Private equity has these gatekeepers. Often these are very large firms, and it's extremely opaque, right? They're essentially, they're taking, it's fair to say that they're taking advantage of their gateway position, isn't it?
Yeah, and what makes it worse is, that the people that ultimately invest into these big behemoth private equity funds aren't accredited investors like you or I who have discretionary capital to put to work. These are pension funds that are investing money from public sector workers, right? Teachers, firefighters, social workers. It's the money that they get saved for retirement, and they trust their government or their state or their city to be a good steward of their money. And as this article pointed out, it's just not happening.
Yeah, exactly. I think what we're seeing here is that, and again, because that's basically not these people's bread and butter. You're right. They have other things going on in life, and they're just relying on the big financial system to make sure that they have a pension or something to rely on later on. And this has become quite perverse, and I think it's quite timely that this appears right now because I mean, it speaks a lot about these big buyout deals, which in a way to me personally, they never really made any sense. It's almost like if you're like a big corporate and you need to jettison a part of your business, there's all these big private equity managers who are really happy to do that for a fee, right? So I think
Oh
it's
yeah.
it's pretty timely because I think I guess we're the challenger here, or one of the challengers that are going to make private equity investing more accessible, essentially by using technology to make it very easy for people to cobble small amounts of money together and actually put that to work in meaningful deals, right?
Yeah, that's absolutely right. And I think we could talk a little bit about what we're doing here, but I thought this article was interesting enough that we should just walk through in slightly more granular detail what exactly is happening here with private equity, with the status quo today, because private equity has a lot of brand cachet to it, right? People want to invest in it. They think about buyout funds, high level deal making, and everybody wants to participate. But I think we should talk about what's really happening here and who's really being affected. So I thought maybe we should spend a little bit just diving into this particular article, which was published in the Times yesterday.
Yeah, go for it. Give us an overview.
Yeah, so I'm not going to single out any particular fund manager here, but suffice to say that the most
Well,
of
the,
the
the
article,
article already does that.
yeah, people can figure it out for themselves, right? But like this article revolves around one of the biggest, probably three or four fund managers in the U.S., right? Like they don't get any bigger than these guys, and they've got an $8 billion buyout fund, and so a few months ago they settled with the government with a $115 million penalty that was paid because they were accused of colluding to drive down share prices of the companies they were buying. Right? Everybody's heard about, for example, the Beats company, Dr. Dre's headphones being sold to Apple for $3 billion. Well, this fund sold it, and there are other like high-level deals that are above the fold in the Wall Street Journal. So this is as big as private equity gets. So we don't know what really happened with this collusion and whether or not they were really guilty. But what we do know is this: that there was a $150 million fine that was paid, and the fund didn't pay a dime of it. Their investors did, and these investors are they're pension funds, like we said. Like their funds come from retired teachers, public sector workers, and there's no explanation as to why the investors paid the bill. And when the Times went to the fund manager asking what happens, and they asked to see a copy of the partnership agreement that made this legal, and this happens a lot now. These fund managers are refusing to provide the agreements, stating that they're trade secrets, right? And when they finally agreed to provide a copy to the Times, they redacted it like something out of a spy movie, right? There were, over 2/3 of the document will have those little black lines through it, like it puts the CIA to shame. And so the Times managed to go out and find an unredacted copy, and this is what they found. Like, well, first of all, most of the redactions were just stupid. Like they were redacting, for example, the clause that showed when the fund's fiscal year ended, as if that's a trade secret. But there were some really important things that came out. So, and this requires a bit of attention span to figure out. But everybody knows the 2-and-20 fee structure with private equity, right? If a fund makes gains, when those gains are paid out, the fund manager gets 20%, and then the remaining 80% go to investors. You're with me so far, right? That's pretty straightforward. Yep. But what these guys have done with their agreement that they made their investors sign is that the investors only get the after-tax gains, not the pre-tax gains. So that 80% can be hit with another 40% charge if you assuming that investor has a 40% tax rate. So the gains that are attributable to the investor could be reduced by 40% and ultimately find their way back to the fund. So now we're talking.
No, that's EAIDTA, right?
Yeah, exactly. It's EAIDTA, not EBITDA, and that's an enormous haircut for an investor, and that's bad enough, right? And you would think that if a fund were to do that and treat their investors that poorly, that the market's going to win in the long run because investors are going to find more efficient uses of their capital, right? But that's not what's happening here. So I think the problem is that the pension fund managers are in on the whole scam, right? So if you look at like a pension fund, whether it's a teacher's pension, firefighters, whatever, these managers, they're public sector workers, and they're stewards of the retirement funds, but they're also bureaucrats, and and like any bureaucrat in the public sector wants to do, it's the bare minimum required to stay out of trouble and appear that they're making smart decisions, right? So just like nobody ever got fired for buying IBM, that old saw.
Oh, yeah.
No one ever got fired for buying KKR or Carlyle or Blackstone either. And these pension funds allocate as much as 10% of their assets to private equity now. And it's easiest for them just to go to the big guys and just allocate 25% here, 25% there of their total private equity exposure to the big top-level funds. And if those funds have opaque accounting rules, and well, no one really has the attention span to ask questions, right? It's all pretty simple. The funds get to take their excess returns. The investors get to provide, or they get to receive a modicum of returns from their pension funds or their pension allocations, but nobody really digs underneath the hood to find out exactly how much they're missing out on. And I think this is it goes to show that the fix is in. Not just on the fund manager side, but with these public sector workers who are supposedly looking after the retirement savings for thousands or even millions of people, of hardworking, not just Americans, but people around the world, right? And it's a travesty. And I think and before I go any further on this, and I sound like I'm just bashing the big PE funds, I want to point out that what they're doing isn't easy, right? Private equity isn't easy. It can be very difficult to structure these deals, and it takes a lot of intellectual firepower, a lot of hard work, and these guys are rightly paid very well for what they do. But what we're seeing now, in my opinion, as shown by this article, is that there's now clearly overreach on their part, and I go so far as to say that a lot of these fund managers or these pension managers are failing in their fiduciary duty to their clients, and worse yet, they don't want to be questioned about it. I mean, good luck to you as a pension saver. If you try to go to your pension fund and file a Freedom of Information request to get a copy of the agreement that they signed with the big private equity manager, it's just not going to happen. So I think the bottom line here is that it's time for investors to start to regain control of their own destinies, right? Take control of that decision-making power Stop allocating to these pension funds that are just giving you a fraction of what you really think you're getting or what you should be entitled to get, and look at alternatives. If you want to get involved in private equity, there are plenty of ways to do it. You could, but the problem is, as a mainstream investor, your ability to actually get a partnership agreement from a Carlyle or a Blackstone, it's next to nothing, right? The barriers are high, the investing minimums are too high, and there's a long line of people in front of you with a lot more capital than you have. So that's the conundrum, and that's, again, we're coming full circle as we always do in these little talks, but this is why we're setting up emerging frontiers, isn't it?
Yeah, you're right, and it's probably like first it was the banks, and then now it's the pension funds. So it seems like this problem of fiduciary honor is traveling throughout the entire industry. And you know what? I mean, to me, personally, again, I mean, maybe it's just because I have a limited understanding of things, but to me, that the mere size of deals, the mere size of these private equity deals, I just found them mind-boggling because to me it was always a bit like private equity players would even leverage themselves up to put more money. And I think you're right because there's a sort of you got the pension funds with all their billions to put to work. You got these private equity players in a privileged position to actually do that for them, and they get greedy because in the end what they get is what they do. They get a carry and they get a fixed fee and all those kind of things, right? So basically, so concretely, Kevin, I think people are living in the illusion that that's still the only thing you can do. Like a lot of people say, like, hey, I got to put my money in a bank. Well, they could keep gold bars somewhere. But I mean, in terms of for private investors, concretely, what can they do? What does a platform like that look like, and how does that exactly work?
Well, I think it looks a lot like the Emerging Frontiers private investor portal that we're building, right? And there are other examples of good private investor networks that are being formed right now. And all of these provide basically an opportunity to look at a wide range of, you could call them angel deals, early stage venture capital. And these are the sorts of opportunities that are now directly accessible to individuals after the Jobs Act was passed in the U.S. in 2012. You see a lot of crowdfunding portals coming online now in the UK or even around the world now. And some close associates of our firm have been evangelizing on this topic. You featured them in your newsletter last week. This is Jason Best and Woody Neese from Crowd Capital Advisors, the guys who basically pushed the Jobs Act through Congress in 2012.
Which is material for a Hollywood production. It's an amazing story, isn't it?
Yeah, it really is. It's really impressive what these guys did, and they're now they're basically leading the charge for the democratization of the investment process, which we think is long overdue, definitely post 2008. And as we can see from this New York Times article, there are a lot of lessons that we still haven't learned. Luckily, technology and regulation are now beginning to facilitate this process that's going to allow individual investors to start getting involved in the same kinds of deals, albeit at an earlier stage in the company life cycle, which is actually, in a lot of ways, quite positive, right? I mean, just think about if you would have had the opportunity as an individual investor to find that Uber or that Facebook or any of these other companies that have experienced amazing growth, even post 2008. And I think the point to make here is that everybody knows that like the odds of one person finding the next Uber are exceedingly low. Those companies are very hard to find. And the key to success in private equity, and just like any fund manager will tell you, just like any angel investor will tell you, is diversification, right? You don't want to just find a deal that you think is the next Uber and go all in and allocate your entire net worth to it. The key is diversification across 25 or even 50 opportunities. The key is to co-invest with smart people, people who are subject matter experts in that particular sector that the company's in, people who understand the country or the region that the opportunity's in, people like us with Emerging Frontiers who understand the markets and rely on subject matter experts to bring good opportunities our way.
Yeah, and it sort of falls into a general trend in the world where you have everything going DIY, I guess, right? It's sort of a self-service world that we're getting into increasingly. And I think
Yep.
one of the things that I also like about these new platforms, what attracts me to it is, for example, you actually have to make sense to individuals in order to be successful in funding. So you have to bring it to a level that anybody can understand it. And what that also means is that you're sort of under pressure to be extremely transparent, because what you're doing is you're using a medium to win the trust of people that you've never met. So you've got to sort of swing out of the park when it comes to sort of like really, making sure that people can say, like, I think I can trust these guys because I think I've seen what I have to see and all this and that. So that, I guess we have the problem that we started this conversation with, it somehow totally gets solved, because rule number one of crowd investing is transparency. And obviously, basically putting everything up on display, and then hopefully that's the only way that you can get funded.
Right. Yeah, that's absolutely right. And when you say do it yourself, I think that's absolutely true. But the technology is now in place, like we already said, where you don't have to do these things on your own, right? There's an entire crowd, a cast of thousands out there with the same goals that you have, which is to advance their own net worth and find those investment opportunities. And you should be able to rely upon, I guess, the judgment of the crowd, or the wisdom of crowds, as that book title goes, right? It's not like you have to make these decisions in a vacuum. And one of the things that we want to do with Emerging Frontiers in the coming months, we've talked about this a lot, is start to create that community of like-minded people that can, find good investments, or identify them, and help each other out with their decision-making process.
I guess if people can find their sentimental partner online to spend the rest of their life with, I'm sure they can find other investors to go with them, right?
Yeah, it's true. I'd say that the online dating world has much higher stakes than this. After all, we're just dealing with money, right?
It's only money. It's only stuff.
Exactly.
Okay, so no, thanks for those insights, Kevin. Again, thanks for watching the Emerging Frontiers TV. There's a lot more where all that came from on Emerging Frontiers in one word .com. We got a brand new website up, where it's almost there, so definitely sign up. What I mean with sign up is when you go onto the website, definitely sign up for our newsletter, because we're up to some really interesting things, and hopefully we can also help you understand all those fantastic exotic places a lot better. All right, thanks for watching, and thanks, Kevin.
Thank you, Baldwin. See you next time.
Until soon.